Hey everyone, and welcome to the Dividend Power Hour. It's great to be back with you because I am back with you. That means I'm recovering. So, I had to take a little break last week. I had a upper respiratory issue and as well as an ear infection. I thought only my kids could get ear infections since I haven't had one since I was about 12. But apparently, I got an ear infection. My voice was shot, so I wasn't able to do the Dividend Power Hour last week. But I'm glad to be back with you guys. I'm feeling much better. Thank you for all the messages and the DMs and everything. So we are back here talking dividends, talking stocks, the economy, and everything that you need to know just moving forward as an investor. It's just an opportunity to engage with the clients and everything. So just happy to be here and look forward to talking with you guys. So if you have questions, make sure you hit the comments and we'll answer those as we go. But with that being said, I do have a slide deck here that we will add, and we will kind of just go through our normal routine. Before we do get started, though, let me know, where are you viewing this from? What part of the country? If you're here in the U.S., if you're out in Canada, I hope you are staying safe with all the fires that are going on out there. And if you're new to the channel, make sure you hit that subscribe button so you're notified anytime that we drop a new video. So we drop new videos on Mondays and Wednesdays, and then we try and do this live stream every Thursday just to be able to interact with the subscribers and answer any of your questions, as well as do kind of a run through on the economy, dividend stocks, growth stocks, whatever you guys want to talk about. So with that being said, let's take a look here. Matthew, good day to you. Good to see you in the live stream here. We got Lex. Here's my new subscriber, Lex. Thank you for subscribing. Great to have you on the live stream here for the first time. He's retired, living off of dividends. That is awesome, just to be able to collect dividends, all the hard work you put in through the years, and now just living off of those, as well as Social Security. He likes dividends, and without them, I don't know how he would manage. So there you go, guys. There is a great example of how, putting in the work, allowing those dividends to work for you, the power of compounding as well. One day you'll be hopefully living like Lex and living off those dividends and continuing just to look to invest. It's not like he's sitting tight, because I know he's messaged me a few times, and it's been great to interact with him so far in the last week. Jim is with Lex. He's also in retirement. Haven't had to dip into my dividend IRA account yet. So that is awesome there. But when he'll do that once his HSA. So that's just proper planning right there. Going through the steps, taking advantage of these dividend retirement accounts, such as a IRA, whether it's a Roth or traditional, whatever works for you, as well as HSA. Those are great. My wife and I use HSAs. We haven't been able to build up as much yet, just because having two small kids, it feels like they're at the doctor's, at least in the wintertime, at least every other week, it almost seems like. But it's been me lately at the doctor, and I didn't get sick from them, so I don't really have an idea there. So Matthew, good day to you. Jim is in Nebraska. Awesome. Thank you. St. Louis for Matthew. Amandu is Dallas, Texas. There we go. Little Texas love there. Lex is in Louisiana. Awesome. David, Lex, and Jim. I'm with both of you on dividends and retirement, but I have not had to use them so far, as my wife is still working. There you go, David. That sounds like a great setup right there. You just have your safety net once you need to get to it. So awesome there. David is in Southern California. What part, David? I am in Orange County here in California, Southern California as well. So maybe we're not too far apart. And then Punisher 66 is in St. Louis County. So, continue to drop questions in there as we go through. But with that being said, let's kind of jump into the screen here that we got. Let me get myself out of the way here so that you guys can see the full screen, and we can get on. All right. So the Dividend Power Hour, this is our slide deck that we go through. This is your first time joining. I kind of just put this up just to be able to go through some main topics in the economy right now. So we'll begin with our economic outlook. So the debt ceiling, since we spoke last, we now finally do have an agreement. And within that, also coming out of it, is the student loan payments are set to continue after a 3-year hiatus. So I have its own section down there that we'll talk about here in a second. In terms of EPS valuation for the S&P 500, still sitting at that 220 mark. We are starting to see some analysts mark that down, some analysts even marking it up. So we're still at the 220 mark, which as of the close today, the S&P 500 is now trading at 19.5 times using that 220 mark for 2023. The last live stream that we had, it was at 18.8. Since then, the S&P 500 has risen 3.5%. So we've had a lot of action since our last meeting 2 weeks ago. And on average, you will see the S&P 500 around 15 to 16 times. But again, very top heavy with the technology sector right now. And because of that, there's going to be a much higher multiple when you have the likes of Apple and Microsoft. Nvidia is now up there. Tesla. These are all very high growthy type stocks. In terms of employment, jobless claims came in at 28,000 this week, and that raised to 261,000. The expectation was 235, so a big surprise to the upside there. Not what you want to see in terms of the consumer and the American job worker. However, the May Payroll Act, which is a little bit further back looking, that came in at 339,000 jobs added in the month of May. So that was a big jolt for the stock market. However, the latest weekly jobless claims are kind of painting a little bit different picture there. Housing inventory continues to remain low as new listings decreased 20%. That where I live here in Southern California, there's not a ton of inventory, especially in my neighborhood, as well as just really across the nation. So it's understandable due to the fact that there's a lot of homeowners right now sitting on low mortgage rates. So unless you have to move, why would you move if you're sitting on a 2.75% 30-year mortgage and move up to where mortgage rates right now are around 6.5%? Just doesn't make a ton of sense. However, there are first-time home buyers that are kind of getting priced out right now. So mortgage rates have recently reached their highest levels since November of 2021. So those could continue to rise. Hopefully they're topping out here, but we'll see what the Federal Reserve is going to do here next week. So I mentioned student loans as part of that debt dealing. We have 40 million borrowers owe an average of nearly $400 per month once those student loans start coming through again. So that's going to take nearly $16 billion to be drained from the consumer's pockets. So a lot of consumer discretionary type stuff. If you think about, there's just not all of that extra spending that we had the past 3 years, really since the pandemic years. So a lot of those consumer discretionary stocks where you thought you had extra money, $400 a month is a good chunk of change. And that's just the average number. So we'll see how that kind of plays a role here moving forward. So if you guys have questions, continue to pop those in there. I'm seeing some of them, and we'll get to them for our Q&A session. But okay, we'll get to this one real quick here with David. Redlands, awesome. So my wife grew up in the Redlands area. Her family still lives out there, so not too far at all from here. So that is awesome. All right. So in terms of dividend hikes, I like to kind of just go through what companies are increasing their dividend recently. So these are some notable dividend hikes in recent weeks. So we saw Lowe's, who is a dividend king, for increasing their dividend 50 plus consecutive years. So Lowe's gave us a 5% dividend increase, which was actually low for them, because if you look at Lowe's, if we bring up, we'll add this to the screen here, and we let's look at Lowe's here. It's a stock I like. Home Depot and Lowe's are great for dividend growth. Right here at 60 years practically for Lowe's now, you're going to get a 2.1% dividend yield on a forward-looking basis. Still a low payout ratio for a company that has paid a growing dividend for that long, and to still have a low payout ratio, that is phenomenal. And Lowe's is doing some great things there. They beat out. I think in our last live that we looked at, we kind of compared the latest results from Home Depot and Lowe's, and Lowe's was actually closing the gap there between those two. So that was a nice to see there in terms of performance and what that CEO is doing to turn things around. But in recent years with Lowe's, it's been a much higher dividend. We've had a 5-year dividend growth rate of 20%. So 5%, we're going to take it. Obviously, it's below inflation these days, but what can you do? They're just being conservative based on where the economy is right now. So another one is Alexandria Real Estate, ARE, another technically an office REIT, but they're more in the biotech life science area. So it's not don't think of your typical office REIT. So, I've covered this in prior REIT videos that I've done. I just did another REIT video where we ranked 10 REITs from best to worst. So if you haven't checked out, that's my latest video. Definitely give that a look, and let me know what you think about a format in the comment section. Did you like that format, that ranking system? I could do it for a ton of other types of stocks. Looking at the comments on the video so far, it seems like everyone kind of liked that. I could take, 10 dividend growth stocks, 10 dividend kings, dividend aristocrats, 10 industrial. I know one person commented on there saying, hey, can you do 10 BDCs? I don't know if I know, 10 popular BDCs to make a decent video out of it, but it's worth giving it a try. So seems like, I'm getting a lot of positive feedback on that video. So that's been good to see, and definitely want to hear it from you guys as well. So looking, what else we got? We got United Health Group, so UNH, they gave us a 14%. So that's going to be the largest of our group today. United Health is known for having a strong growing dividend. So we could scroll over here to Seeking Alpha. We'll look at UNH, United Health Group. You can see you're going to get a low dividend yield of about 1.6%. A low payout ratio, but you can see here the 5-year dividend growth rate of 17%. So that's some solid dividend growth. They did 14% this year, right around that average, and they've been growing their dividend for almost 15 consecutive years now. And United Health is the largest stock in the in the Dow Jones Industrial. And for those of you that don't know, the Dow Jones is actually a price-weighted index, unlike the S&P 500, which is based on your market cap. Your price per share doesn't matter all that much, but with the Dow Jones, your price per share does matter. And that is actually one reason a lot of folks believe that Apple actually cut their, did a stock split to kind of bring their per share price down, just because the weight that they had within the Dow Jones was so massive. But now that leading spot is United Healthcare. So they have a $490 price per share. As you can see here, as of the close today, they were up about 1.7%. So the Dow Jones leans heavily on United Health. So that's a little nugget there on United Health. And then lastly, we had Johnson Controls gave us a 3% dividend hike in recent days. So those are our notable dividend hikes. Those aren't all of them, but those are some notable dividend hikes that we've had there recently. So question, let's move over to Apple. What are your thoughts on the new Apple VR headset? It's got a low starting price. And the funny thing I saw there was that is their starting price. You know how it is with the iPhone. Get the iPhone for a starting price of $899. Well, most people buy the $1,000 one. So I don't know what else it's going to have, but the starting price is around $3,500. Let me know in the comment section. Are you going to be buying the first generation Apple VR headset? I'd love to know. I mean, it's supposed to be ready next year. It's going to start here in the US. It's just the stock actually fell after they released it. So it's interesting. Was it the starting price? Was it the technology that we still have a cord that's hooked up to everything? I mean, it's a start, but a lot of the folks, especially on CNBC, did an article saying that they used it. They compared it to the Meta one, and it was light years ahead of that in terms of clarity and everything it was able to do. Not something I'm going to be in the market for. Unless we hit the lottery here and something goes nuts and I just have money to blow. But, would be curious to hear if you are going to be on that list to buy the first generation Apple VR headset. Let me know there. So not for me, for sure. I feel like I'm in the same boat with you. David, love the Apple VR headset, but I am biased as a long-term shareholder since 2013. I'm right there with you, Apple shareholder, but I could see what you're saying. I hope people buy it, but I'm probably not going to be in the market to buy it myself. So I hope people buy it in terms of me being an Apple shareholder, but yeah, definitely not for me. Lex, won't be buying it either. No on the headset for Peter. What else we got? Jim's going to wait on the headset. I remember when GPS came out, $1,000. Now you can get one for $99 or less. You are correct there, Jim. And Slim won't be buying that VR headset as well. Matthew brought up a good question here. We could pop on. Heard on another channel, 1.5 trillion of commercial debt will need to be refinanced over the next 3 years. How will this affect REITs, good or bad? So it's definitely it's something to be mindful of. I think it's the type of REITs. That's one reason there's a huge sway between different types of REITs there. It's one reason that office REITs are struggling so much right now is because one, they're struggling with occupancy, not getting tenants in there because they still have a lot of hybrid. There are a lot of companies that are bringing people back to work, especially here in Southern California. My wife works for a large insurance company. They have been, completely hybrid for about 2 years, and they're slowly bringing people back in to work, 2 to 3 days a week, depending on your level. If you're a higher, executive, then you need to be in there 5 days a week. So, yeah, I think it's going to depend on, number one, the quality. So there's still a lot of, high quality REITs that are out there that are, think of something like a Vici Properties, that 100% occupancy. Alexandria Real Estate we just touched on. They're technically an office REIT, but they still have high occupancy numbers and their revenue numbers are growing. So they're not your typical office REIT. So I think that's the sector that I have zero exposure to the office REIT sector, with the exception of Alexandria Real Estate. WP Carey I own. They have a small percentage of office REITs there too, so that's kind of a red flag for me. But that's definitely a great question, and it's going to be REIT to REIT. So definitely something to be mindful of. So that was a great question there, Matthew. And commercial real estate. Yep. David, no on the headset, even though I am a shareholder. Buy the stock for slim, not the product. Kath, no way on the headset. That price, that it is a crazy price. Hey, Mark, why is realty income getting hammered? Slim, that's a great question, and I think it's really predicated on a couple different items. One is that what we just talked about with the debt, with higher rates, REITs definitely get hammered just because they have to pay out 90% of their taxable income out to shareholders in the form of dividends. Now that's great for us dividend investors, but in terms of growth, you're going to rely a lot more on debt. And right now, debt is at a higher rate than what we've seen in the past. However, Realty Income they're an A-rated REIT. They're the gold standard when it comes to REITs. So they have a huge advantage when it comes to going out and getting debt compared to a smaller REIT that doesn't have the track record, that doesn't have the investment grade tenants that Realty Income has. So when it comes to Realty Income, I'm just taking this sale and just nibbling at it. Anytime, I've said it in the past, anytime that dividend yield for Realty Income gets over 5%, which I think it's right at 5.1% right now, has been proven to be a great time to add shares to Realty Income, just based on evaluation. If you look back, anytime it goes over 5%, that's when it's been a great time to add. So that's exactly what I'm doing here. It's at a cheap valuation, I think around 15 times AFFO. They normally trade at a premium in their sector, their net lease retail sector, near 19 times. So quite the gap there for Realty Income, and one to definitely take a look at there. So the dividend investor, great to have you and connecting on Twitter. Depends on which REITs you're looking at. I like Agree and Vici. Those are three awesome REITs there. I don't think Agree Realty gets enough credit like they should. I did a video comparing them with Realty Income, and you can kind of see the close comparisons between the two. And then Vici, as you know, if you follow my dividend portfolio, is my largest REIT holding within my dividend portfolio. Just love what they're doing. The casinos, it's 20 plus year leases. So very long-term leases. They're the largest landlord on the Las Vegas Strip. And if you've been down the Las Vegas Strip within the last decade or 2 decades for that matter, you often do not see a for lease sign out on the window. It's hard a business to move. You can't move hotels and casinos all that easy, and it's prime real estate, to be honest with you. So love what Vici's doing there and what they've really done and the growth they've seen over the years. So let's keep moving. I see those questions there, and we will keep rolling with them. So I just want to get through these. So sticking with Apple in the VR headset, that's going to have a big impact on the service revenue, because not only are you going to buy the product, I'm assuming there's going to be service things that you need to make it work. You'll have the product, and then it's buy this subscription or add this particular app or software and stuff to do different types of things. We'll wait to see that. But in terms of Apple revenue, you can see the growth here. Since 2012, we went from 12.9, and before that, the year before that was at like 9.4. So we were in the single billion-dollar range, but we've gone from 12.9 as of 2022 now, $78.1 billion. I mean, just their service revenue segment alone is larger than many companies out there on the S&P 500, which is just phenomenal. That is growth of over 500% since 2012. So Apple's doing some big things there with the service revenue. Once they kind of get you into their ecosystem, buy the product, which is already at a lot of business models are out there. Is like, okay, buy this cheaper product and then get you in the ecosystem and then charging you this subscription. Apple's figured out how to charge a massive amount for their product and then also add on subscription stuff. So, they have the cloud within their service that is just going berserk as well. So now let's move over to consumer health. And I know Lex had a question regarding this when he emailed me on a subscriber question. So, the consumer health is something that everyone's watching very closely right now, just due in large part to how much consumer spending equates to GDP. It accounts for up to 70% of GDP from just consumer spending alone. So many economists, though, are going back and forth now lately as this is like, I don't know, going back to 2008 or, the early 2090s before that when we had our recession. This one has been the most foreseen recession coming in, decades, going back to our decades comment. But, we've had retailers like Target, Walmart. These are low-cost retailers. Dollar General, who's down 30% in the last month, who came out and they were just crushed on, some stagnant type earnings, but the guidance as well is lowering. They're seeing, Walmart made some comments on their earnings call about how they're seeing consumers move down from regular price stuff down to private labels. So think of it like Walmart's Kirkland brand or Target's Kirkland brand. They're not as well made and high quality as Kirkland is with Costco, but that's a different story. And then, that's starting to weigh. They're starting, the middle and lower end consumer is starting to feel the effects of these higher interest rates, which usually folks say take about 6 months to start working their way through the system. Student loan payments are going to have a huge impact, especially on inflation. We already talked about the lack of consumer discretionary spending. So that's going to be huge there for GDP as well moving forward. But the one thing that has remained strong, there's a lot more than one thing, but the unique thing, even though consumer spending seems like it's coming down, what consumers are choosing to spend on is luxury and leisure and travel. Folks are still traveling. They're still getting on airplanes. And we've seen a lot of the airliners actually increase guidance in recent weeks when they gave out their recent quarterly reports. So that's definitely something to kind of take a closer look at, and that's exactly what we're going to do here. So we're seeing spending growth really come down. There's a flood of how much people were able to save during the pandemic, working from home, not spending a ton, and then all of a sudden we saw the services spend just skyrocket. So that's what that red line is. That's your services spend. But you've seen how you have services and expenditures, but you can see how that has slowly eroded since the pandemic, and it's hit a new low here in the recent years. So services growth has flattened. That's going to be your gray one. Your red one is actually your expenditures there. So I already mentioned Walmart noted folks moving down to private labels. According to JP Morgan, we've seen an increase on credit card spending each and every month here in 2023. So that's something definitely take a look at. But where before, now we're just shoving a ton of things on credit cards because we can't afford it. We're seeing the credit card debt. It's not like it's getting paid off because the credit card debt also continues to climb to new all-time highs. So definitely red flags are flashing all over there. And then we touched on jobless claims, which rose by 28,000 just in the recent week. Remember, the latest jobs report was was a May picture. So that gives you the entire picture for the month of May. This jobs report, this weekly jobless claims report is as of the prior week. So this is the latest and greatest that we have right now. We're up to 261,000, which is the highest since October of 2021. Again, another red flag to be aware of as an investor. You don't want to be jumping all in right now. So right now we have 1.6 million folks that are receiving unemployment benefits here in the US. So the consumer is starting to show some signs of cracking. And now we're headed towards a Federal Reserve meeting where we may get another hike and put further pressure on the consumer. So not only are we seeing companies that are starting to tighten their budgets, we're seeing layoffs continue to uptick. It started in the technology sector, but now it's really broadening out across. And now we're seeing consumers that are starting to feel that. They're putting more on their credit cards. They're not able to pay off their credit cards. They're coming down on the quality of the food that they're buying. We still have high gas prices, especially here in Southern California. So definitely some things to take note of. And now moving on to the Federal Reserve. So we have the next Fed meeting, which begins next week. So they have their 2-day meeting, which will be on June 13th and 14th. And we will get a decision on whether the Fed will choose to hike rates yet again. And that would be our 14th consecutive hike, I believe. Or are we going to finally pause? This is really what has been moving the markets, is where folks have thought, now is finally the time that we are going to pause. But right now, when we look at the CME tool here, you can see that 74% believe of economists that took this believe that we are in fact going to pause. And they don't think it's going to be a long-term pause. We think it's more called a skip. So 74%, I would say the large majority of that folks believe we are going to skip and then hike one more time in the July meeting. And we have 26% that say, no, we are going to continue with the plan here, and we are going to keep hiking in this June meeting. So, and then the bottom graph there that you can see is the same, economists looking there, the same CME tool, but this is for the July meeting. So what do we think folks are going to do? Do we think they're still going to remain flat? So 35% are saying no hike in the July meeting. 51%, and that's no hike in June or July, I should say, because that's keeping the Fed funds rate at the same exact rate it is right now. 51% believe we will have a 25 basis hike. So that's hard because that's that could be in the June meeting or it could be in the July meeting. But then there's still 14% that believe that we're going to do 2 hikes. We're going to do one in June and one in July. There's an off month for the Federal Reserve in August, so they really have only 2 more meetings to get one more hike in. I believe for my opinion, I believe there is one more hike to go, and then I think there will be a prolonged pause from there. So whether it's a skip and one more hike, then a pause, or we hike, get it over with, and then a long pause. I'm not in the camp that believes we're going to be cutting rates. I know there's people out there that are cheering cutting rates, but that's not really something to be cheering about, because if you understand how the Federal Reserve works, and when it increases rates and decreases or cuts rates, when it's cutting rates, that usually means there's a fundamental issue with the underlying economy. So the economy is not going to be in a great situation if we are in fact cutting rates. So that's my take on the Federal Reserve. Now let's take a moment to get to another question. Do you have, speaking of consumer and consumer spending, do you have any big vacation planned for this summer? So this is the first, I usually go to Maui is kind of my vacation spot. That's my, favorite place to visit on earth. I've been all over to Europe and done all the, Eiffel Tower and go see Rome, and all that stuff is beautiful. I just love sitting on a beach by the water, maybe with a cocktail in my hand, enjoying my time there in Maui. But this is actually the first year that we are not doing it. So we're taking a year off. We're going to take the kids next year. The other thing is airline rates are through the roof, and I have to buy 4 tickets. So that's not as easy or economical anymore. So, but do you have, let me know in the comments, do you have any big plans, vacation plans for the summer now that kids are, I know my kids are out of school now for summer break. I'm sure many across the US are as well. So let's hear it in the comments. I'm going to catch up on some of these other questions here as well. David, welcome to the live stream for the first time. That is awesome. Thank you for everything. You helped inspire my. That is awesome. This is why I do what I do, is just to teach folks about investing and how you can actually do it. You can be your own portfolio manager. I have a 6-week investing accelerator course where I get to work with clients one-on-one, whether you've been investing in your prior life at all. If you have no investing experience, or you do have an investing experience, I work with clients all the time, taking them through my 6-week investing accelerator course. And it's just so awesome to see where they came in at the start and where they're at the future. Just, super pumped, and have a roadmap on how to reach their financial goals, where everyone has their own financial goals. So it's hard. You don't want to compare one person that started a decade ago to someone that started today. Everyone has their own unique goals. Everyone has their own unique risks. So it's just awesome to teach folks about that, and also save them thousands and thousands and thousands of dollars over a lifespan by using a financial advisor, when really you can do this and you can be your own financial portfolio manager. Spot on, Dividend Investor CPA. I own O and Vici with ADC on my watch list. It's a good one right there. Lex bought some O in the last 2 weeks, taking advantage of that 5% yield. What are your thoughts, Matthew, on BLN? I haven't looked at BLN in a while. Let's see where they're down 1% today, down 20, almost 25% in the past year to date. Pretty much flat so far. So this isn't one I've looked at all that much. They've always had a sizable dividend yield. It's just not something where you get a ton of growth from since they've been around. So it just doesn't fit my portfolio right now. But I haven't looked all that closely to give a opinion on where they're headed right now. You can see that they've really been trading in a pretty tight range between like 15 and 16, 17 bucks since October of 2022. So just really stuck in the mud right now. So, but I haven't really looked at them in a while. So I'll have to pass on that one. Jim, your tier list on REITs was great. Thoughts on GLPI compared to Vici? I've actually done an article. So I write on Seeking Alpha as well, and I did an article on GLPI comparing the two. It's a unique sector to be in because a lot of folks will they'll bag on Vici, or I'll hear it in the comments on Twitter or in my DMs saying if we're going to hit a recession, gambling's going to be down, foot traffic's going to be down in the casinos. But remember, Vici isn't an operator. Vici is the owner of the real estate. So that, although they look out for their operators, they have the best operators, in the world, really. They have partnerships with their operators. They're just worried about getting that rent check. And through the pandemic, they survived a pandemic and earned 100% of their cash returns from rent. You saw realty income dip down to 60, 70%. You saw store capital at the time dip below 50% of what they were supposed to collect on a given month. They were only collecting 50%, having to put payment plans. So I think that speaks to the quality of Vici's tenants, and that's why I'm always going to stick with Vici over GLPI there. And that's just my take on that one. David giving the thumbs up there to David, or the dividend investor giving the thumbs up to David. The dividend investor, yes, Apple is an ecosystem king. Absolutely. Look at the headset as an underlying step into locking us into their ecosystem, possibly tenfold in the future. So the dividend investor has some big plans for that VR headset there. Peter's he's going on vacation. He's going to the Victoria Island in Canada. Never been there. I don't know if I've actually been to Canada yet. That's definitely on my list of places to visit. So you'll have to let us know in a future, after you get back, you'll have to let us know on a future live, some of the perks of Victoria Island there. Who else is going on vacation here? We got some more questions on stocks. Okay. Has ABBV fallen enough to make it a buy yet? James, great question. This is a stock, and for a long time, it was actually one of the largest single stocks in my portfolio, my dividend portfolio, but I've actually been selling it over time here at the start of the year. And it's really an overreaction to the Humira stuff. We've seen that. We've known about the Humira cliff. But at the same time, there's just stagnant growth here over the next, call it 18 months. Why those new and upcoming drugs, Rinvoq and Skyrizi, they're growing exponentially each and every quarter. However, they're still, in terms of total value, they're still quite small to take that over. But management believes that the combination of the two of those will far exceed that of Humira's peak sales, which is, as an investor, I still own a good chunk of AbbVie. It's still definitely towards the upper echelon of my portfolio. But right now, given the stagnant growth, I probably want to see it closer to, we'll say, 120-ish. So I think that's still plenty above, probably about, so we're at 137 right now if I'm looking at AbbVie. But in terms of the forward-looking multiple is still high. You'd have to go out 1 or 2 years, and I don't like to go out, multiple years when I'm looking at a PE ratio there. So I'm just, kind of hanging low with AbbVie right now. Still love it. But I think the dividend growth is going to be a little bit smaller in these next few years until we start ramping that back up yet again. So definitely love AbbVie, but not looking to add to it right now, even at this current level, as I do have a good chunk. If you don't have a good chunk of it, maybe this is a good spot to add a few shares with AbbVie there. So Rick, is it too much to have 25% of the entire portfolio in O? That's definitely, you just have single stock risk there. So you've seen it here with Realty Income in the fall, really across the REIT sector as a whole. And you're going to have, over the past 5 years, they're up 18%, but over the past year, you're going to have 25% of your portfolio down roughly 10%. That's a lot of risk. I don't have that type of exposure. I'm usually around a 5 to 10% for my top holdings. Even my ETFs and index funds are about, 15 to 10% on an individual stance, I should say. But individual stocks, I probably would shy away from that high for my portfolio. But if it's something that where you're just worried about the dividend, living off the dividend, that's a safe dividend, I can understand why it's that high. So it's definitely based on your strategy, based on your end goal in terms of if it's passive income, is it total returns and share price appreciation. So just something to be mindful of that now. Are we now post-recession? Well, we haven't really been declared in a technical recession yet. There was a brief moment in the prior years, but in 2023, no, not yet. We're still waiting for some. We've had positive GDP numbers, albeit barely, but we're not in a recession technically yet. Some say we are, though. Lex, how do we sign up for the course? So that's that one you can just email me. So I market that a bunch on Instagram, and you can we could set. What I do is I set up interview calls, because I don't accept everyone. I get a lot of people that want to sign up for the course, but they may not be a good fit for many different reasons. It could be cost. It could be particular things that they just want to invest in. I've done some one-off stuff in the past before, but now it's really just focused on this 6-week course that I teach, and it's bought to be customizable though. So, even though I have my things that I want to focus on for the 6 weeks, if you're an investor that has been investing for, 20 plus years, and the real basics, which is the first thing that I start on before we start diving into more of the details, that's probably something I'm going to skip. And then maybe towards the end, we get into something, say like options investing. Maybe you want an introduction to options investing. I've had some investors come and say, hey, I know the basics. I want to get more into options investing. Okay, well, let me take out this first chunk, this week 1. We're going to move all the weeks up. And then in week 5 or 6, we will add options investing. And then always at the end of all of my courses in the final week is really a portfolio review. So again, not a financial advisor. So I can't give specific advice, but I can look at things and say, okay, just to be aware, you have, at the last question, you have 25% exposure to realty income. And I'll give reasons why, why that's a higher risk thing. Or, hey, just so you know, you have about 70% exposure to the technology sector. If you're high on the technology sector, awesome. But maybe that's not something you're aware of. So we do a portfolio review. We look at my portfolio and just things to consider there. So definitely you can reach out to me on social media. You can email me. Lex, I know you have my email. Any of you can email me. My name is Mark. My email is mark@rusonfinancial.com if you're interested in the 6-week investing accelerator course. So definitely reach out about that. So we just started our June group. So I have a fresh group. It's been exciting to meet with those folks here at the start. So what else we got here? Slim, FXAIX is on fire. SCH is down. So really, SCHD is down due to its lack of technology exposure. So, SCHD isn't built to outperform the S&P 500 each and every year. And I know that's why a lot of folks are bagging on SCHD right now. It's focused on dividend growth stocks, and Apple's of the world, Microsoft of the world. They're not going to have massive exposure because they're not big time dividend paying stocks. Broadcom has really helped SCHD, or it'd be down a whole heck of a lot more. That's their top position right now, and they've been, kicking butt there. So just understand, kind of the differences between S&P 500, very tech heavy, SCHD not as tech heavy. So there are other dividend growth ETFs out there that do have a lot more tech exposure, and I covered those in my recent video on 4 dividend growth stocks. DGRO, VIG, and then DGRW is definitely a good one to look at that I've added to recently. What else we got here? James, thoughts on Altria? So Altria, they have what was their yield at these days? Altria I own within my dividend portfolio, albeit it's probably slightly below the middle of the road within my portfolio. So now you're getting 8.3%. It's kind of been trading sideways for much of the past year without the big drawdown there at the start 12 months ago, so probably 11 months ago. But it's really just been trading in a range of 44 to 48. It's very cheap in terms of price to earnings. Usually when economic times get tough, I've talked about this before, when it's unfortunate, but economic times get tough, we hit recessions, the use of cigarettes goes up, and it's going to benefit a company like Altria. So I could see in the near term, Altria, giving you a good total return basis. But again, you're not going to get a ton of share price appreciation. So you really want to just add those together to get a total return. So you're just, right off the bat, you're going to get 8.3% in terms of dividend. It has a high payout ratio, but I think it's still safe. It's usually, always in that 70% range. So if it got up towards the high 80s or 90s, I'd be a little bit more concerned with Altria. All right, what other question? I'll take a few more before we keep moving. I can see a ton of them here, but this may be a very loaded. Oh, I love loaded questions. But I have no debt, own my house. Oh, I feel like this is a call-in on the Dave Ramsey show here. This may be a very loaded question, but I have no debt, own my house, and will be inheriting nearly $4 million in a year. Should it all go to dividends? Current portfolio is $58,000. So that is a loaded question. It's these are the types of questions that I answer on this investing accelerator course. It's really, we build a roadmap in the first 2 weeks. We understand, what is your risk? What's your risk appetite? Are you someone that wants to take more risk? Are you someone that wants to, be more hands-off to where we automate it? You don't have to really look at individual stocks. You don't want that individual stock, or maybe you want a little bit. So we build it more. We're going to say, okay, we're going to gear you more towards ETFs. We're going to go through a bunch of ETFs and really build out a roadmap and a strategy based on everything that you tell me. So we're gonna look at time horizon. How long till you retire? Do you want passive income when you retire, or are you more towards getting a lump sum that you can build up? I just care about total return, whether it's passive income, whether it's growth stocks. And again, in the investing accelerator course, we're not focused just on dividend stocks. I love dividend stocks, but I also own growth stocks. It's trying to be fully diversified, and we talk a lot about that. So we really build up that roadmap. So it's really going to come down to what you want. If you want dividends in your life, if you want to focus on compounding that 4 million into more and more, and not worried as much about, outpacing the S&P 500 and being up 60% or up 100% every year, then, dividends is a great spot. But, I think the real answer is you want to diversify that into safe investments, and just split it up into whether it's ETFs, or individual stocks if you're a hands-on investor. But definitely, there's a lot of great ETFs out there. So it's really based on what you're looking for in your strategy and roadmap, if you've never kind of outlined that. So I've never had that much, and honestly a bit lost on what to do. So, if you're interested, definitely email me, reach out to me on social media, and we can definitely get you set up for an interview call with me. It's just a short 10-15 minute call going more into detail on what I cover week by week over the 6-week course. And definitely see if you're interested, see if we're both a good fit. That's one thing I'm always looking for on the, it's a two-way highway. I can't sit here and preach all of this stuff if someone's not on the other end that's really looking to learn. I'm looking for those folks that really want to be their own portfolio money managers for the rest of their life, build a blueprint for them to reach financial freedom down the road and reach their goals at what age they want to reach them. So that's the whole purpose behind the course there. So awesome there. Lex is saying, go all in with the dividend income. I love it, Lex. Lex loves himself some dividends. Pfizer versus AbbVie. Interesting. So I've really, really been looking at Pfizer a ton lately. Both stocks, the whole healthcare sector has really been down. And that's the area that, I've been leaning towards on a lot of my buys. If you follow me on my dividend portfolio, I'll be doing my monthly portfolio update. I'll be publishing that here within the next 24 hours. So you'll see a lot of healthcare related stocks on that list, both in the portfolio and stuff that I've been buying. So, Johnson & Johnson's down there. Pfizer's been getting crushed. AbbVie's been down as well. So we just touched on AbbVie, but Pfizer is very unique. They're trading at a very interesting valuation right now. Definitely, in my eyes, one that I am taking a closer look at and may add to here in the near term. You're getting that dividend has crossed a 4% yield now. You're at 11 times earnings. If you look at forward, you're getting close to single digit earnings there. So, this is definitely one that, I want to take a closer look at, and am looking at heavily. I'm looking at this one closer than I am AbbVie right now, but I don't own a position in Pfizer. I do own one in AbbVie. Lex wants 25% in SCHD. That's definitely, now's the time to keep adding to SCHD with it down and everyone kind of piling onto it now that tech stocks are back. So Journeyman portfolio, what's your take on Cigna Corp and the health insurance space in general with regards to government regulation? So yeah, CI is one I jumped into. I jumped into it probably about a month ago, maybe 2 months ago now. I don't remember how long I've had Cigna, but I'm down on it. It was trading at a reasonable valuation. Now I think it's trading at a cheap valuation, especially when you look at the adjusted earnings. You're going to get a PE below right at 10 times. So that's very intriguing. But I'm also right now, I'm not looking to add more to Cigna, even though it's at these current levels. I'm actually looking closer at United Health, which is one we touched on here earlier in the video. I love the dividend growth that they offer. I love the price point. They're the largest. They're doing a ton of things with their Optum and United Health stuff. So, I like the health insurance sector, which is the question you really asked there. And these are two good ones, Cigna and United Health. So, I think it's always going to be, there's always talk of regulation. Same thing with the pharmaceuticals, bringing down drug prices and stuff like that. So, but until we actually see change, there's always a lot of chatter, but until we see change, I'm going to keep with the status quo. Doug, great to see you. Thanks for joining. The Great Og just bought some DG. Good move. Where are they at today? Let's take a look. And I see the other ones there, and I'm going to keep going on the slides here, but so they still haven't recovered. So it's more, so what I like to do here is I want to see things stabilize. But obviously you're getting a price 30% cheaper than it was about a month ago. So, if it's a long-term entry point, then I think this is a great point, or a great entry point, I should say. But if it's a short-term play, then, that it's still falling and still pretty volatile. But, if we do fall into a recession, sure, consumer discretionary spending is going to be down, but I think folks are going to you're going to see the higher income folks start coming down and say, hey, I'm going to be shopping more at Target. I'm going to be shopping more at Walmart. I'm going to be shopping more at dollar stores. So this could be a good entry point here for Dollar General. I'll quickly get on this one. Spire View, pretty much the same thing. It really comes down to, are you an options investor? Do you want to play options with them? If you are, SPY's my answer. Otherwise, it really doesn't matter all that much. All right, so let's keep going here. We didn't get much questions on. I got a few answers on vacation plans. So I'm gonna assume there's not very many vacations planned so far. So now the emphasis on what I wanted to get to, even though we're at 46 minutes here, is talking about the different types of dividend stocks. So, folks say dividend stocks, but that's actually very broad. There's many different types of dividend stocks that have different, you're investing in them with a different strategy. So Apple is a dividend. I always go, oh, Mark, how's that a dividend stock? Pays 0.5%. Does it pay a dividend? Okay, it's a dividend stock. NVIDIA, that one I can understand a little bit more because it's at like 0.04. But we're going to put it on the list anyway. So there's different types, but I'm not investing in NVIDIA or Apple for the dividend. I'm investing in that for the growth, and the dividend is just a few extra bucks on the top, and they're also growing their dividend. Microsoft's and Apple, low yields, even Costco, low yields. It's dividend growth, 10%, dividend growth, 10%. And I love dividend growth. So I'm still getting a little bit of growth in terms of growth stock, but I'm also getting dividend and dividend growth from those stocks. So have a strategy behind why you invest in certain stocks. If you're just looking for the income, then maybe higher yield is more of your answer there. But for me, out of these four, you have low yield, moderate yield, high yield, and dividend growth. You could add REITs in there, but really REITs can just sit in the high yield or moderate yield. So low yields is going to be your Apples, Microsoft, NVIDIA, Costco's of the world. Moderate yields, these are more mature companies, slower growing, but consistent. So you have Coca-Cola, Pepsi, Johnson & Johnson, and CVS. Oh, my voice is starting to go. And then high yield, we already touched on Altria, Philip Morris, AT&T, and then Verizon as well. And then dividend growth, those can fit really in any of those three buckets. So HD, I would call a moderate, a 3% yield, but they're also increasing their dividend at a 15% clip. Tractor Supply, I would put them in the low yield category, but they're increasing their dividend 15 to 20% a year. Lowe's, I would put them in the moderate category. I think they're at a 2 to 3%. I think they're little over 2%. So they could be either low or moderate. But they're increasing their dividends 17% per year on average over the past 5 years. It was low this year at 5%. Starbucks increasing it at 12 to 15% rate. Broadcom's at 25% rate. Now, I don't expect that because they had some high 50% dividend hike years. So, just the stuff to be mindful of. Dividend stocks is a broad name, but there's different types of dividend stocks that you can invest in. Also, ETFs. There's ETFs out there that are built just for specific strategies. So you could have dividend growth, which is SCHD. You could have DGRO, VIG, and DGRW, which I just touched on all of those in a recent video. You could have high yield ETFs. These ones are really just focused on getting you a higher yield on stocks that are mature and pay higher yields. So that's VYM, that's the Vanguard High Yield Dividend ETF. You have HDV, and then you have SPYD. And then there's general dividend ones, more broad. So SCHD isn't really focused on dividend growth. They're actually a broad-based dividend ETF, but they actually have the fastest dividend growth out of the other three that are actually dividend growth ETFs. So I put them in both. I put SCHD in both categories. One reason I really love SCHD is it really checks off all the boxes. SDY is another general dividend. Now, if it's just income, so you have the higher yield ones, which they're not like crazy yields, 3, 4, 5% on those ones. But then you have the income. Those are the JEPs of the world, the JEPQs of the world, where you're getting double-digit percent, and it's really all predicated on stock options. So selling out of the money covered calls, selling at the money covered calls, and then also paying dividends from the underlying positions they own. Again, your upside is capped because of that, but if it's just income play, those are definitely ones to look at there. So this leads us to another question. Looking at the ones we just looked at, which type of dividend stock is your favorite to invest in? So, all of you listening, I've had folks that say they're at retirement. You have some folks that are, 20 years old that are watching right now. Maybe a longer time horizon. Maybe they're just dividend growth or low yield, more growth. It could be growth stocks. Maybe it's not dividends at all. Just let me know in the comments. What is your favorite type of, we'll just say favorite type of stock to invest in? Doesn't even have to be dividend stock. And I'm going to catch up on some of these questions. Doug, Mark, what's your take on some of these inflated PE ratios? I think that's something to be mindful of. Definitely it's not something where I'm jumping into it. You may not be right away, but the market tends to correct. There's a reason that the S&P 500 has traded at an average between 15 and 17 times and trades at 19 to 20 times right now. We're in an inflated market where, unless the earnings catch up, which, we saw that better than expected earnings, but the earnings really need to catch up to the price. Otherwise, something has to give. There's signs of the consumer starting to give. So if you track these close enough, you could have, there's ways to utilize options in a safe way to protect your portfolio and to also make gains on those as the market falls. So like right now, I had some covered calls that I'm selling, out of the money covered calls and positions that I own. So if the stock falls, I'm collecting premium. If the stock continues to go up, I sell the covered call at a specific rate where it's like, okay, I have a ton of gain in here. Let's take a little bit off the table. If it gets called away, no problem. That's perfect. Credit spreads, as well as just flat out buying puts on the SPY. So, it's still doing a lot of trying to gain, around $2,000 per month in terms of option income. We've got off to a great start so far here in the month of May. So, that's a couple ways to play it once you see these high valuation price points. Beige. Sup, Mark? Do you like any of the regional banks? So in terms of regional banks, the ones that I would look at are, this one's more of brokerage, would be Charles Schwab. I've stated that before. I like where the Charles Schwab is right now in terms of valuation. And then also another one is US Bank. This used to be a Buffett favorite for you. I think they're the highest quality in terms of US or in terms of regional banks. So those are really the two. I already have a larger position in Bank of America, which is trading at a very cheap valuation and continues to do, and will be a great entry point long term. That's why I keep nibbling at that one. But in terms of any other banks, I'm not really interested in jumping into any of those. So, Slim, is a portfolio full of ETFs worth it, or should we include single stocks? I think that goes back to what's your strategy? What is your game plan? What is your risk appetite? How involved do you want to be? I know plenty of people out there that just have S&P 500 ETFs, and then they sprinkle a few other ETFs around it, maybe like an SCHD or a triple Q and stuff like that, and they make great returns. I mean, it's just like, why give myself the headache of the individual risk and trying to guess and put all my eggs in one basket with these individual stocks? Now, I know there's much higher upside with individual stocks, but also much higher downside. I enjoy being hands-on. I enjoy the battle and the competitive nature. But again, even for me, it always focused and predicated on building a strong foundation. This goes for relationships and stocks. You can put them together. It always goes back to a strong, firm foundation. And what I attribute that to is ETFs and index funds need to be the center of your portfolio. So that's kind of my take. Is you can definitely make tons of money, build wealth to reach your financial goals just utilizing ETFs. And really, to be honest with you, that's what a lot of these financial advisors do these days. They're collecting their 1%. And when you actually look at, a lot of people don't ask, hey, what am I invested in? What are you investing in each month? Oh, I was just putting in an S&P 500 and a couple ETFs here just to keep it safe and simple. Okay, well, that's something you could do without paying 1%, which could add up to hundreds of thousands of dollars over a 10, 20, 30-year time span that you were just paying this 1% percentage point on your investment over to them. So that's, again, a reason why I started teaching this investing accelerator course, is to create ways to make you your own portfolio manager. What else we got? Hi, Mark. Sorry I'm late. No worries, Fabio. We are still here and still rolling. Peter, a little bit of everything. All right, Jim, let's see what you got. I've got a good mix of all types of dividend stocks. Peter's got a mix. Jim's got a mix. So I don't have a favorite. It's like picking your favorite child. I understand. As long as my portfolio can give back $1,500 per month in dividends, I can live with no little price growth. That's the great thing about dividends. If you invest, and especially for those of you that are just beginning your dividend investing journey or interested in investing in dividend stocks, it's not about the year one yield. That's what so many people look at right now is, oh, I'm just getting a 2% dividend. Well, look at what's the dividend growth. Oh, it's at 15%. Awesome. Do you understand the power of compounding dividends? Well, no. Okay, well, then don't talk to me about the year one dividend income with your smart remark, because it's a process. Dividend investing is not about the year one dividend income. It's about the year 10 plus dividend income. Right now, Warren Buffett, if you look at Coca-Cola, let's look at Coca-Cola real quick. Let me throw it up on the screen. So let's look at Coca-Cola real quick. Perfect example, the one I use a lot. Coca-Cola, right now, you can get a 3.06% dividend income. Woo! Awesome. 3%. I'll take it. But that's nothing to write home about. Right now, because of the power of compounding dividend, Warren Buffett kept taking his dividend income and reinvesting it into Coca-Cola. So he still added fresh money from time to time, but the dividend income is no fresh money from your bank account. That's the company paying you and you taking it back and adding more shares, really at zero cost. It's just the dividend income you're reinvesting. He continued to build shares, and Coca-Cola continued to increase its dividend each and every year. Now, if you look at it going back, if you looked at the actual year, it was at a 3%. But today, based on getting that, not saying that dividend income was any more invested capital that you put into Coca-Cola for Warren Buffett's sake, he now earns over 50% on his invested capital. That is astonishing. Right now, if you buy Coca-Cola, you're owning 3%. Warren Buffett's earning 50% because he continued to compound that money each and every year. Let me get to a few more. Slim, you are welcome. Lex with Mo. Sam, how is it going? And then Peter, let me get to that one, and then we'll keep going here. I have just growth as well as dividend stocks and ETFs. So it sounds like a good mix there, especially if you're a young investor and you're looking for more of that growth. Growth is obviously right now, especially tech growth, is a great spot to be in right now. So, having it all goes back to diversification. I'm a dividend investor. I own growth stocks. I have Google. If you want to say Apple's not a dividend stock, well, then I own Apple too. But there's other, growthier companies in there that don't pay dividends that I own. So it's all about diversification. I'm not here to say only invest in dividend stocks and that's it. That's what people get it wrong and get things twisted. So we're not just here to invest in dividend stocks, although that is a good portion of and the majority of my portfolio, dividend paying ETFs, dividend paying stocks. So, but not saying that that is the only thing that we need to invest in. All right, what do we got here? So there's opportunities still out there. So, we touched on, I think it was Doug with the higher inflated PEs. That's, across the board in terms of S&P 500, but that's also high tech. So the one thing that you want to look at is if you look at the S&P 500 and compare it to there's I think it's RSP. Let me look it up real quick so I'm not just speaking BS here. So yeah, RSP is an ETF, and it is the equal weighted S&P 500. Comparing the differences between those two has been a way for you to see if a rally is top heavy, which is exactly what we're at right now. Because if you look at the RSP, and I'll bring it up on the screen here, this is where you take the S&P 500 and everyone really has the same weighting. So Apple, even though it's the largest company in the US, has the same weighting as a little tiny company, the smallest company in the S&P 500. Everyone has an equal weighting, whereas the regular S&P 500 is market cap weighted. So if we go over to, we'll just use SPY right now, and we'll go to holdings, you can see Apple and Microsoft make up over nearly 15% of the entire S&P 500. So, those Apple's up, Microsoft up, Nvidia's doubled, Google, Meta has doubled. So you can see this top heavy. So are we really in this? Is things starting to turn around? Are we really in a bull market where all the stocks and companies are starting to do well? Well, if I look over the past year, the weighted S&P 500 are actually down 2%. So what does that tell you? When the other S&P 500 is up over 10%, the equal weighted one is down 2%. That sounds a little top heavy, and I'm going to be mindful of, maybe not throwing a ton of money into those ones right now, especially after those runs you've seen in Nvidia, especially after those runs you've seen in Meta. So, could be wrong, but that's just my take right now. But there still are opportunities out there, which is what we were discussing here. And one of those is, so these stocks right here are the 5. Hopefully you watched it, and hopefully you still will watch it if you haven't yet, of my dividend stocks for the month of June. And these are the percentage gains since I put that video out. So Johnson & Johnson's up nearly 4% since that video. I believe it was last week. AT&T is another unique one, up 3%, nearly 3%, a stock that I've really hated for much of the past 2 years. Luckily sold out of it in the low 30s before that pandemic plunge. But had my reasons. Just, management, that's always a key, is not just looking at fundamentals. You want to look at things outside the box, and management is one of those. Seeing poor acquisition after poor acquisition, but now they're starting to get back to their telecom roots. So something to look at there. And that is up 2.8% even after the fall that they saw in recent days from the Amazon news, where they're going to start providing sales service to Prime subscribers. Well, they're not building their own telecom service here. They're going to be using either AT&T, Verizon, or T-Mobile. And that's what folks didn't understand. The stock was down 5%. I added more to it. Small position in my portfolio, but I'm back in AT&T. United Health, another one that I'm looking at closely, up 2.1% since the video. Qualcomm, pretty much flat. They dipped a ton down to about $100 after their earnings report, but then skyrocketed back up, back into that 110, 115 range. And then Tyson Foods is a unique one. This is one I put out. I don't own it, haven't bought any yet, but one that I'm watching closely. It's down 3% since the video. But food is definitely something. It's really recession proof if we do in fact fall into recession. Now it's down for other reasons, cost cutting measures. Their comps are really tough. They had the 2 biggest years in the company's history during the pandemic, but they've run into some short-term issues. But Tyson Foods is one of the biggest food providers that is out there today, and definitely one to look at these extremely cheap valuations if you look 1 year out. So definitely opportunities to be out there. And last question of the day before we wrap up, we're a little over an hour right now. Do you think the S&P 500 will end higher or lower than where we closed today? Do you have? Are you looking for that recession on the back end or on the back end of the year? If so, then you probably think the S&P 500 is going to be a little bit lower. If you think, hey, there isn't going to be no recession, the Fed is going to figure this out. We're going to have a nice soft landing. We're going to continue going up. Nvidia is going up 200%. Meta's going up 200%. It's all golden right here. Or, maybe your answer is we're going to be flat the rest of the year. So let me know in the comments, where do you believe that the S&P 500 will end the year? And then, if you guys do have any other questions, I know we're a little bit over an hour. This is the Dividend Power Hour, not the Dividend Power Hour in 5 minutes. But hey, I'm here for overtime now. So we'll stay for a few minutes to answer any other questions that you guys have there. So let me scroll back up here through the comments. Doug, Mark, last year there were many bargains. There were indeed many bargains, especially if you were lucky enough to jump into Nvidia and Meta. I mean, even if you were lucky enough after they went up 50% to get another 50%. So There were a lot of bargains, and that's one reason that I'm looking. There's a lot of down sectors right now, and if you're a long-term investor, healthcare is going to be there. Johnson Johnson's going to be there long-term. AbbVie is going to be there long-term. Pfizer, all of these companies that are down right now, take advantage of them. Take the opportunities that are out there. They may not be the big growth drivers of 2023, but if things flip, these are going to be your leaders. Energy, healthcare, these are those defensive sectors. Right now, everyone's on cloud nine thinking everything's going to be fine. And that's why you have exposure to technology. I'm not saying don't have exposure to technology, but the diversification on what I'm buying, right now, I'm not buying technology that much. I'm focusing more on the beaten down sectors. So, and then last year it was more, let's buy some more technology. So obviously we're not always going to get it right. But that's kind of the mindset that I take there. So it keeps my portfolio balanced. This is Peter talking about how he has all the different types. He has growth stocks, dividend stocks, and ETFs as well. All right, the brown guy. Hi, Mark. I just got 10K from lotto winnings. Wow. I hope this is a real story because that is pretty awesome. I was thinking of putting half of it into SCHD and split the rest into Mo, T, and Johnson Johnson. What are your thoughts? So it looks like you're looking for some good yield there. Obviously, I don't know what your portfolio looks like. I'm not a financial advisor to tell you what you should buy, but those are all stocks that I own in my portfolio: SCHD, Mo, T, and Johnson Johnson, with T being the latest addition there. Mo I haven't added to in a while. It's kind of just, it's there. I'm collecting my 8% dividend. Don't expect a ton more than the dividend yield. Johnson Johnson is one of my largest individual holdings and a stock. They should be getting a ruling here. Hopefully, once they get that talc issue behind them, hopefully they can here soon. I believe the stock will once again be headed higher from here. What else we got? Alex, how can I find reliable dividend paying companies? So if you're just looking for companies that pay a dividend, you can use something simple like Seeking Alpha, which I use. I go, that they have the dividend yield on there, any Yahoo Finance, Google Finance, whatever it is. Or it's just a quick, Google search as well. But, if you don't follow me on Twitter, I'm at dividend_dollar. I'm talking about dividend stocks all the time, listing, here's 10 great REITs, here's 10 dividend growth stocks, here's 10 dividend kings, just to give people idea of some of the top different types of stocks that are out there. So definitely give me a follow there and on Instagram as well. Jim, I'm with you on enjoying individual stocks. I don't own any ETFs unless you count BRKB, which is, technically, I could see why you call that ETF. It is in a way, but it doesn't pay a dividend. And Warren Buffett's been pretty clear on that, on how he likes to reinvest the money, but he loves dividend stocks, but does get me into annual meetings. There you go. So did you go to the annual meeting this year? I have not been live to a Warren Buffett annual meeting. So, hopefully that was a cool experience if you did in fact go to that. So Jim thinks the S&P 500 will close modestly higher from here. So he's thinking a little bit of upside still to go. I'm in that camp where I think things are going to really be flat or, even slightly lower from here. So, pretty close to moderate. Peter believes it's going to be flat and sideways. I'm in the same camp there. Fabio, I think the S&P will be lower. The tech market will burst at some point. They're starting to see some cracks there, in terms of hitting resistance lines, especially for Apple right now. High valuation, hitting some resistance there. So that'll be a close one, because when that one falls, again, we just looked, Microsoft and Apple account for nearly 15% of the S&P 500. Once that one starts to fall in a sizable manner, I think it'll take the whole market with it. What else do we got here? Whew, I can't keep up with them. Fabio, I think will be lower. Oh, we just did that one. Bird flu and their CFO getting arrested. Yeah, that's true. The bird flu they did mention there. Temporary issues though, and you added to your position. So this is Tyson is a name that you already own. Awesome. Is a paper trading options platform. There are paper trading options platform. That's a great way to learn, because you don't want to jump into options trading. That's a great way to lose money real fast, is just to go all in or just start messing with options. So definitely there are paper trading options available out there to use. So that's definitely a good suggestion there. Jim has an answer for the brown guy. Buy 10K worth of scratch offs after winning it for lotto. He's saying double down on your lotto there. So Thanks, Mark. Appreciate your opinion. Utility stocks. I actually don't even own any utility stocks there. Let's look at some of the sector's down about 10% over the past year to date, down 5%. So there are some places to look here. Next Era, that's one I've covered before on this top list. Just looking at this top 10 holdings, Duke Energy is one I've looked at that pretty closely, but not really have any opinions there. Besides, Next Era is really one that I've looked at more closely lately. Did a recent video on it, but this is one where, similar to the energy sector, I kind of just look at the XLE. I would look at the XLU here, just because it's not a sector that I dive into all that much and stay with all that closely, just because it's more slow moving. You're going to get a good yield from a lot of them, but it is just a slow moving thing, and I'm looking more for that more dividend growth there. So. And then the last one here is TSN in trouble. It certainly looks that way right now, but I believe they can get things, turned around. They have a action plan that they're putting in, that they're telling us at least. But one thing for me is I always want to see things start to bottom out. I want to see the action plan start to take effect there before I jump in. So it's one that has an opportunity right now. So depending on if you're risk averse, saying, hey, this is a great valuation before this pops on some sort of news, I want to get in now. I can totally understand that. But for me personally, I haven't jumped into to TSN yet, just because, as you guys had mentioned, there are a lot of issues going on there. So that's really all I got for you guys today. We had a great group there, almost 100 folks that were joining us here live at the peak of this live thing. A lot of great questions from you guys. A lot of newcomers, Lex joining us for the first time, and many other names that I didn't recognize before. So we continue to grow this community. When you guys have questions, I love to talk stocks and really appreciate the time that you guys take out of your day to sit here and listen and to be interactive. Again, if you're looking for more content, definitely sign up for my Dividend Investors Edge newsletter. There's a free newsletter that goes out each and every week, delivered straight to your inbox on Mondays. Unless the stock market's not open on Mondays, it'll come on Tuesdays. But just covering, the top 5 articles and economic things that are going on. You'll see an economic calendar for that week. If we're in the earnings season, you'll see an earnings calendar for some notable companies that'll be reporting earnings. Some dividend stocks that are being upgraded or downgraded by analysts. A lot of folks like that sector as well. We'll look at a recap of the major indexes. There's a ton of great information. Just to quickly read through it probably takes you less than 5 minutes just to skim through and just keep up to date with the markets without diving into a bunch of different articles. I bring it all into one. But if you want to take things an extra step, then sign up for the premium subscription, where you'll get access to my dividend portfolio. You get monthly dividend portfolio updates each and every month. You get 2 stock deep dives, which I look at individual stocks, do a research report. They're usually about 8 or so pages, giving you information on the company, giving you the recent earnings updates, giving you valuation. We also have a valuation dashboard that we'll be rolling out here that I just showed folks recently, which is just covering stocks that are within our coverage, doing discounted cash flows on, looking at price targets, where stocks are at right now, intrinsic values, just to help you make more informed decisions to reach your financial goals. So definitely sign up for that. That is very cheap right now, limited time, $19.50 a month. That's less than $1 a day to join. So we have a great community there where we do other things as well. And so I hope to see you there. Thanks again for interacting. Thanks for joining the Dividend Power Hour, and we will see you next week. Have a great weekend, everyone, and stay safe. Take care.